are listening to What's Up Digital Lending, the podcast that explores the exciting world of digital lending. We make a deep dive into the most important issues and talk to the leading minds of the ecosystem.
Welcome everyone. This is episode number 10 of What's Up Digital Lending. Today I have three wonderful guests. Stäuble, founder and CEO of the Fintech lender Teylor. Maik Wehmeyer, co-founder and CEO of the service provider Taktile, and Andreas, COO of Raisin Bank. In this episode, we look at the year 2024 and we discuss the current situation in lending as well as the trends for this year. By the way, all three companies are members of our association. My name is Constantin Fabricius and I'm the host of this podcast. Before we start, pay attention please. The content of this podcast is expressly not to be considered investment advice. It is intended solely for your information. We do not assume any liability and will not share any profits. So, let's start. Welcome Patrick, Maik and Andreas. Great to have you in the show.
Thanks, Constantin. Great to be here.
Hi, everybody. Great to be on the show.
Andreas, can you kick us off very high level and set the scene, please? What's going on in lending in Europe?
We, from Raisin Bank, we see three things happening currently. On the one hand, the demand for lending products increases. Cash has a price now. So companies, SMEs, but also customers are looking for short-term solutions. Factoring and, for instance, will certainly have place in the coming years to increase cash reserves for companies. We see, but at the same time, also regular financing investments, the demand will be there. At the same time, we see that the costs of capital have increased and also the costs of liquidity. So from the supply side, there will be restrictions because not everybody can lend out at a price that is compatible with what customers expect. So certainly the whole debt financing becomes a challenge from the supply side. And certainly we expect to see at least some defaults. I mean, we have been having a long time, 10 years, with historically low default rates on loans. And also most digital lenders have not seen a cycle yet in their company history. So that is certainly a challenge to look out for how defaults will develop over the next years.
Yeah, that's my question for Patrick. How is specifically the asset class digital lending position in this environment? What trends do you see?
I think it's a pretty interesting time for the asset class. I think that one of the biggest changes that we're seeing is on the investor side. I think there's been over the last couple of years, obviously a massive boom in interest in private debt as an industry and the ability to invest into the asset classes that are generated by by platforms such as Teylor and other market participants. At the same time, there's kind of a counter trend in that today you can get the same type of returns that maybe 2-3 years ago you were expecting from a private debt portfolio. Today you can get from buying treasuries of certain countries and things like that. So obviously the return expectations, the quality expectations, etc., from funding providers has changed massively as well. So I think it's certainly more difficult to get funding today, despite the fact that there is probably more capital in the market. So I think that's one key thing that we're seeing a lot of. The other thing, obviously, that we are seeing as well is that it is, as Andreas correctly pointed out, the first time that a lot of players are going through a down cycle after about a decade or more of basically free money. So there are many platforms in the market that are struggling, that do have to rethink how they are positioned, that have to maybe for the first time in their history think about how do they properly handle risk management and things like that. So I do predict that at least amongst the fintechs, there's going to be some exciting new players, but probably also some players leaving the market, some consolidations. And I think it's definitely a survival of the fittest, Darwinistic moment worldwide amongst the fintech lenders on the market, which is an interesting thing, I think, to look out for 2024.
Yeah, what's your view, Maik?
So my view is, Taktile in itself is not a lender, but we build infrastructure for lending companies. So we do have quite an insight into the market, different countries in Europe, different products, short-term, long-term. And I would definitely agree, what Patrick and Andreas said. There is a shift, so lenders have to rethink, which leads to many of them rethinking the risk management. So like if in 2021 and 2022, it was quite easy to give out money because it was pretty much for free to get it. So people opened their floodgates. What's happening now is people really sit down and think about how can I achieve profitability and how can I do that? Can I use alternative data sources? How can I actually like rethink my customer segments in a more granular manner? And definitely across many lenders we work with, we do see that the most teched up lenders do have an advantage because they can act faster, they can react faster, they can iterate faster. And that's definitely one. Patrick, you said it's survival of the fittest. I would definitely, put that into the bucket of fittest in terms of how, technology driven are you as a bank, as a lender, and how can you kind of like translate the new requirements from your debt facilitators and the market and your investors into actually real-time credit strategies.
And I think the interesting thing, maybe, Maik, I'm sure you've seen the same thing on the market, is that it's not only fintechs or alternative lenders that are kind of having this view. It's even very much the case with traditional lenders. And also because I think for the first time in obviously many years with the new interest rate environment, there are traditional lenders that are realizing that there are other types of credit that, suddenly are profitable or interesting to look at because the margins and the returns are suddenly there. And there it makes sense to dive into these areas and maybe do that for the first time or do it better than they've done before. And that's where tech, can play a huge advantage and where there is definitely a big upswing in interest in this area.
Very, very much so. Some of the even biggest lenders in the UK and Germany, they're coming to us and say, well, we've used to give out term loans, but how can we now think about, for example, B2B, buy now, pay later, which is, another term for a much, shorter cycle loans. But if it's, a much shorter loan, like you still need to make money with it. So you cannot like have so much manual review. You cannot have so many underwriters on that topic. So how can you technology driven wise increase adoption rates, increase automation by using new data sources? So like I think those trends of new lending product is something that everyone is looking for. The question is always like, how do you do it in the end? How can you launch them? How are they regulated? How can I like tell my investors that they will be profitable? So there's a lot of thirst in the market for trying out new things, which of course is very, very interesting.
Yeah, that's an interesting aspect that you mentioned. Are there specific areas that are likely to perform better or worse than others? For example, in an earlier podcast, you, Patrick, mentioned not to be so optimistic about crowdfunding. Is this perhaps something that will get under pressure in the near future?
I honestly don't think that there are very many real crowdfunding platforms left in the world, simply because it's just not in my view, just not a scalable business model. I mean, the problem that you have with crowdfunding is not necessarily that whatever the underwriting or the loans that they're giving are not necessarily good loans. I mean, they might be good loans, but if you want to have a scalable business and a plannable business, you need to have enough capital that you can scale your origination whenever, as you need it. And the problem with the crowdlending and crowdfunding is that you have to scale on the one side the retail investors at the same pace as you're scaling the origination activities. And as of today, if every one of these retail investors needs to be KYC'd, onboarded, etc., have their own custodial account or something similar, I don't think that there's really a feasible economic way to make that work and deliver attractive enough returns to investors without taking unnecessary risks. So if you look at a lot of the platforms that maybe today are labeling themselves as peer-to-peer lenders or crowd lenders or whatever, the reality in the background is that they're probably are either a couple of institutional investors or one or two family offices, high net worth individuals that are in fact providing 90% of the funding. And it's more just a label. Will this always be the case? I don't think so. I think you can make the business model of crowd lending work in that, if you have methods to, for example, exchange KYC between different platforms, if you can maybe tokenize the assets that you're generating to make them more easily available to third parties and you reduce those hurdles. And assuming you get enough liquidity on the market, it can certainly work, but that's definitely not how most crowd lenders are doing it in my view. I also think just purely from a risk return perspective, there was a large boom in crowd lending was potentially an interesting asset class maybe 3 years ago, where you're earning a negative interest rate on your bank account and whatever other products you're investing into maybe doesn't give you much return. But today, if you're earning maybe 5% net on a crowd lending platform, I don't really see why you would do that rather than any of the other, much safer opportunities that are generating 5%.
I agree and disagree at the same time. So, of course, crowdlending faces some challenges to return expectations in a market where the deposit rate was 0 versus 4%. Of course, the upside, given the risk profile, needs to be considerable, and the return expectations may not be met. At the same time, many crowd finances are in project and mortgage financing, and that itself, so the fundamental market, irrespective of the banking product, is under pressure because we know that many projects are delayed, they face increasing costs and so on and so forth. So that itself, the fundamental market, has a hard time. And of course, regulatory requirements also for crowd lenders with the new licenses out there. So this is certainly not a boom year. You're right. Most crowd lenders, Raisin Bank works with a couple of them, are not pure players. So they also have institutional money. Some crowd platforms actually make a total shift. So basically their crowd is a proof of concept before institutional investors take over. Some have a deliberate mix of both, and different types of projects are refinanced by different type of investors. I think it's too early to say that this will vanish. I could see that it has a place also in a changing rate environment. So we expect that rates may go down as early as mid this year. So that, again, the pressure from alternative investments in a more safe environment like deposits will get less competitive. I think the jury is still out whether these models and in what form they will survive. I think it's too early to say that they shouldn't be there. At the moment, they still have a place, and they will need to evolve just as any other business.
Yeah, definitely.
Maybe another, because you ask about new products that might be enabled in 2024 by the pressure coming up. I think, if we talk about B2B, one of the trends, and there are a lot of new fintechs coming up, also quite successful ones that actually want to use marketplace data to offer embedded lending products. So like one of the biggest role models is Shopify. Most of us maybe have built an own web store on Shopify at some point in time. Right now, Shopify Capital makes more than 50% of their total profits. And the reason is that in the end, you want to actually know what a merchant on your platform. So you're like an Amazon seller, for example, and who knows better what your business health is like than actually Amazon itself. I think it's very hard for like a bank to get the data on your historical sales data. It's very hard to understand how well do you treat your customers. And it's also very hard to understand what your business actually looked like the last couple of years, because you just do not have that data. And companies like, let's say, Banksware or Tilta, there are a couple of ones even in Germany, they try, and it's very hard from a technology perspective, but they try to really look at the very proprietary data that traditional lenders and banks don't have, and then come up with a new credit model and risk model that actually allows you to make a much more thorough risk assessment than any other lender could do. And I think that's definitely one way how to rethink how technology can drive better lending decisions. And that's, especially a case for B2B.
Maybe to add on that, I totally agree that being able to score risks based on data and also customer access, right? I mean, people are not on Shopify because of the banking products, but they take it at the point of sale. So what is sometimes called embedded finance. And that's certainly a trend. And we've only seen the beginning. I'm pretty sure nobody wants to go to a bank to get a loan, but everybody wants to finance something. And if I can get it at the origin of my original business, then that's always the preferred solution. At the same time, but that's not only a data access point, it's also a customer acquisition cost point, because I see that a lot of growth in the last years was bought way too expensive. And especially if we're talking about shorter term products, if I have a 20-year mortgage, right, I can dilute my acquisition costs and justify them over the 20-year period. But if I talk about 1-year lending, even buy now, pay later or factoring with 30 days on average or 60, 90 days, it's harder to justify high customer acquisition costs, and it's harder to justify high operating costs. So we have many of our partners where we work in loan fronting. They have classical banks, incumbent banks, to refinance all the debt. However, these banks are not able to have proper unit costs in customer acquisition and customer operations to hand out these loans themselves. They're happy to refinance it, but they are not happy to do the operations and the work around it and to attract customers at digestible customer acquisition cost. So that also plays a big role for these market-driven lenders, because there the customer is already there. It's more a matter of conversion and not of gaining the customer in the first place.
It's a great point. Yes, I mean, like that in the end is even like the customer experience makes things so much easier, and by that reflects in the customer acquisition cost. It's a great point, Andreas. Yeah.
Although I do think one of the things that we will see in 2024, I mean, if we're talking about lending forecasts, I know that there are many players on the market, as Andreas and Maik, as you both said, that are very focused on sitting on top of these channels, on top of the marketplaces. Where are the customers living and interacting? My concern, if I were either an investor or something, or a founder of one of these companies, is, let's take the example of that you are, serving a certain segment through the Amazon marketplace, for example. You're having an e-commerce product for Amazon sellers, just as a random illustrative example. You might use the keyword proprietary data. There is nothing stopping Amazon from today to tomorrow saying, I'm going to make it much more difficult for you to access this data, or I'm going to use this data myself and fund these customers on my own. So my concern, and I think that we will start to see this more and more in the coming years, is that a lot of these lenders that are built exclusively or focused primarily on certain marketplaces are going to get into competition with those marketplaces. Because as you just said, Shopify is doing it, 50% of their profits from this business. Amazon is already doing this extremely extensively in the US. They have a Luxembourg banking license, and they have guaranteed more people and lower cost of capital than any of us fintech lenders. So if they wanted to, they could kind of move into this market and probably push out the fintech marketplace lenders relatively quickly. And I don't think that's happened that much yet, or at least not been very publicly that we know about it. But speaking of 2024 fintech lending trends, I think that's something that we're going to see more and more of, because it does work. I mean, Amazon is already doing it, and they would be stupid not to do more of it, especially if you see, for example, Shopify, as you said, making 50%.
On the other hand, it dilutes their valuation, right? I mean, let's be honest. The multiple you get on a bank book versus the multiple you get as a tech platform is a bit different. So while there is availability and certainly advantages of these platforms doing it themselves, there are also costs in terms of their positioning against shareholders and their valuations. That's why I think we haven't seen yet, and may not see in the near-term future, big entries of the GAFAs into that space. It has a price to pay, and that's certainly in terms of valuation.
Yeah, that's true. If I put some data points on that, like both arguments, I think are very valid. We power a couple of those players. I was just in San Francisco last week, and one of the biggest players, embedded finance players in the US, they are just right now negotiating with Amazon on that deal. And they're really being squeezed right now, the way you described it, Patrick, by Amazon saying, look, we could also potentially build it ourselves. Like right now they get a commission by the lender, but why not, if they think they can use the data, why not monetize on that? So I think it's Amazon is one of the biggest players there. I think it's much, much harder for, let's say, a smaller marketplace in Germany that sells toys for kids to really build up their own credit expertise, hire like a lending team. So I think there probably is a cutoff between the top 5 players in the market, and then why offer technology and software for the long tail of marketplaces that can definitely not afford it. But just that anecdote, they're really being squeezed right now by Amazon in terms of margins and negotiation power.
Yeah, I can imagine.
But Patrick's point is certainly right. I think there's a place for both. There's a place for those investors who like to go through these established channels because the customer flow is there, the data are there. And there is certainly a market for independent players who also distribute risks a bit better, right? I mean, you have highly correlated risks on a platform. If the platform goes down tomorrow or nobody sells on eBay anymore, then you may have a problem of highly correlated lending assets. That's then, a different risk profile. So there is a place for both types of lenders and lending investors.
Yeah, certainly.
Okay, thank you. That's been quite interesting, that flight over the environment. But let's drill a little bit deeper under the headline, Crucial Success Factors for Fintech Lenders. Maik, Taktile published a survey on the state of lending where you guys interviewed CEOs, chief risk officers, and lending experts to identify their primary concerns. What exactly did you find out?
Yes, I would love to talk about it. I think, Patrick, you were also one of the participants in the survey, so you you now get the full rundown.
I'm familiar, yeah.
We interviewed more than 100 chief credit, chief risk officers, lending officers, CEOs of fintech companies, of banks. So really across the globe, not only in Europe, because we also wanted to figure out not only what has happened in 2023, what will happen in 2024 across more traditional banks and lenders compared to fintechs, but also how are emerging markets reacting towards the United States, towards Europe. So it's quite a broad survey, and I don't think we'll find time to discuss everything today. Maybe 4 findings I think are worth mentioning, where I think would be interesting with Andreas and Patrick to discuss. So number 1, we figured out that 67% of lenders say that they've been negatively affected by rising capital costs. I would be super interested, also for Patrick and Andreas to get their opinion on how it has affected Raisin and also Teylor. Number 2, 47% of the participants identify increasing profitability as their top strategic priority. We did talk about that at the beginning of the podcast. I don't think it's a big surprise, but I would also love to get anecdotes of the magnitude from the real world there. Then an interesting one, 57% of participants plan to enhance their ability to add new data sources to their credit decisions. We already talked about embedded lending now. I think there are many other new alternative data sources like open banking one could use. And I think, maybe spending a minute on experiences there would be very interesting. And then 37% want to improve the frequency of their credit policy adjustments, maybe connecting to, Patrick, what you said earlier, survival of the fittest. Adjusting your policy much more often is, in the end, a result of being what you described fitter. And I think people just want to iterate faster, and people want to adapt faster, just in terms of interest rates go up and you have to adapt and they go down again. And every time you have to react. But yeah, those are the 4 main findings that I think are very interesting and to discuss. But maybe if we start with the first one, just repeating the negative effect by rising capital costs. Patrick, Andreas, how has that been trickling down into your business?
Yes, I have a funny I have anecdotally, I obviously get asked this question a lot, but anecdotally, one of the interesting things that we noticed was that the effect of the rising rates was much extremer, negatively speaking, in the first maybe 3 to 6 months when the kind of interest rate environment started changing and rates started going up than it has over the last, couple of rate hikes. I think in kind of 2022, early 2023, we still had a lot of borrowers, or I guess potential borrowers, who are coming back and saying, why should I be paying, this much more than I was paying in the past? My mortgage is still at 1%. Are you guys crazy? And there was a lot of pushback to the price increases in the beginning. And then it took about 3 to 6 months for borrowers or potential borrowers to kind of get it into their head that rates were going up and that is the new reality. And then at some point there was then a flip where people were kind of, I wouldn't say desperate, obviously, but they was kind of like, if I don't close it, lock in this rate today, and if I come back in 3 months or in 6 months, it's going to be even higher again. And then the conversion or the resistance, let's say, dropped down quite dramatically. So that's, I think, been just anecdotally kind of the behavior that we've seen in our borrowers. The biggest impact that we've honestly seen is that certain industries are more concretely impacted by others. So it's potentially not even directly, or it's partially because of the rising rates environment, but more indirectly, not because our rates are higher. So we used to do a lot of business for construction related companies, stuff like steel companies that were making things for the construction industry. Obviously, the construction industry and real estate industry is not in the same place that it was maybe 2 or 3 years ago. So that's a big part of the business that has fallen away. But other than that, people factor it in and they're kind of mentally accepting it at this point in terms of the borrower reactions. I don't know, Andreas, how your partners are seeing it.
I agree. So to your point, it's exactly so Raisin Bank works with, I think, some 30 or so loan platforms as a partner. Of course, in the last years, we've seen many potential new entries who didn't really know their stuff. So I usually meet 5 to 10 new potential partners every month. And I'm looking exactly at those points that you're saying in a partner, right? So do you have stable funding sources? So also funding that is reliably there, even if the rate changes a bit or the risk profile deteriorates a bit. Is there access to customers? So how do you get your customers at customer acquisition costs? Do you know what you're doing in risk management? And do you have unit economics that actually allows you to be profitable at a certain point in time that is not in 20 years? So this is exactly the criteria we've always been looking for. And in the past, we've seen many players who said, I can lend out, I don't know, for 10%. Refinancing costs are close to zero. So it doesn't matter how good I'm operating on the risk side, on the operation side, on the customer acquisition side, because somehow it will pay. And if I get a lot of equity investors who bear with me for a couple of years, I can burn money and it doesn't really matter how I operate my business. These times, fortunately, gone, right? So today, you have to up your game and you have to know what you're doing. And certainly access to funding at reasonable costs and finding reliable partners is one of the things. There's always somebody who will give you money, but partners who scale, partners who are reliably there, that's harder to find. And that's what we also see in terms of new entrants to the market. There are way less new entries in the last 2 years than there have been in the years before. And one of the reasons certainly is access to funding, among other things.
Maybe to build on that, exactly what you're saying, Andreas, is what I always tell my team, it's like right now for us as Teylor, and I think if you're a alternative lending platform or a fintech lender that has these things under control, as you've just said, it's an incredible window of opportunity because all of the players who didn't manage it will be gone from the market at some point or other, or there's opportunities for consolidation or something like that. And unlike in most other industries, at the moment right now, we don't have the kind of new startups, or not as many new startups kind of breathing down our neck, catching up with us, because as you said, there just aren't that many people funding these companies or these many startups coming into the market. So our kind of view is that the next, and this window of opportunity will only last for a certain thing, but that the next kind of 12 to 18 months is an incredible opportunity for us to grow, or for the players that were able to get the things that you said under control. Huge opportunity to gain market share, and that's what we're very bullish on this opportunity for the players that still remain in the market.
Especially, and what helps is, so traditionally incumbent banks, who still have the largest market share, let's not fool ourselves. I thought a couple of years ago they will be catching up dramatically. They made some acquisitions, so some of the alternative lenders were also bought by incumbent banks. And I thought now's the time that they will finally, invest in technology, invest in risk automation, invest in their processes, and so on and so forth. However, I'm less optimistic than I was a couple of years ago. So I think these acquisitions and these also strategic development have been paused. I don't know what these banks are busy with, but certainly the progress and thus the challenge for alternative lenders, I'm less optimistic for incumbent banks than I was a couple of years ago.
Maybe talking about, alternative lenders, and like you both mentioned, fintechs coming in, they have to ramp up the game. How can they actually differentiate from more traditional lenders and banks? One of the findings, I briefly mentioned it, was in the report that 50% want to enhance their ability to add new data sources to their credit decisions. It's one of the things. It doesn't really matter where we talk to potential customers. It always comes to questions. So what can I do outside of the traditional bureaus? We did talk about, marketplace data, but I think two other big ones that often come to mind is using open banking data. There are players like Plaid or Tink or TrueLayer that do offer to connect, that develop the service. And maybe to give an explanation of open banking here, that allows you to very easily connect different bank accounts to the lenders. So they have like one interface where you kind of like add your login details, and you can like easily connect to your Deutsche Bank account, to your Commerzbank account, to your BNP Paribas account. So that just gives fintechs and lenders the ability to get historical banking transactions. I think a second big one is accounting data. Everyone would like to see cash flow statements. It's a big pain. Patrick is, I see him on the video. He's smiling. Probably has a lot of people in underwriting operations who try to get out signal from cash flow statements, from balance sheets, from the P&L. And I even have experienced it myself, maybe before we pass on to you, Patrick and Andreas, when that anecdote, when we raised $20 million of capital at our Series A, we had that in the bank, and I wanted to get leasing bikes for all employees. And we got rejected by that leasing offering because our CREFO, one of the German bureaus for B2B data, didn't have a good score for us. And I said, look, we are burning 200,000 euros per month and we have $20 million in the bank. Like you probably from your model, we should be very viable for the next many years. And I'm just asking for a couple of bikes, but they kept rejecting us. And they are like, if you would, as an alternative, use open banking data and you could see how much money is in the bank and how much money we are burning per month, it would be a very easy credit decision for us to give us banks. So there definitely, we did fail the traditional system. There, a more teched up lender would have definitely helped us to get the bikes. But Patrick, Andreas, what do you see there in the market? Is it something that also you as leading players, Teylor and Raisin, are looking into? And maybe also a difference between B2B, Patrick, and also more consumer side, Andreas?
Yeah, I mean, for us, it's a huge topic that has been frustratingly slow to move forwards. So for us, obviously, I think we do only B2B lending, so our customer base is relatively heterogeneous. So a 5 million revenue company or a 10 million revenue company in Hamburg might be completely different, and the numbers have to be viewed completely differently than the same size company in another industry or region or whatever. So my dream was, of course, always exactly as you described, Maik, to press the button and I get the accounting data in, and we do open banking and connect to all of these information sources. The reality that has stopped us so far, at least not stopped us, we've certainly not given up, but slowed us down is two things. So firstly, because we're doing only SME B2B lending, our average borrower or contact person at the borrower is a 57-year-old German male. So not necessarily a digital native, usually working in the industrial segment. And when we even ask them to think about, connect your online banking or connect your DATEV, get your PIN for your DATEV and connect it here. If we're lucky, they know what we're talking about, but much more often than that, they also often just say, like, why would I do that? Here's my PDF. Can I not just upload it? Why do I have to now do what is an API, and why do you want my PIN, and all of those kind of things? So the hurdle from the customer to actually, in our maybe a bit older non-digital native customer segment is quite high. And in the majority of time, they just want to upload the documents and not kind of connect anything. And the second thing that we've also always had, let's say, back and forth about is when we're speaking to the larger, especially institutional investors, they obviously, for their own investment committees and investment decisions, they want to have, let's say, third-party validations about our underwriting and our credit scoring and stuff like that. So you mentioned Krefo earlier. If I make the Teylor score, let's call it, and I rate your company as an A+ because you guys have 20 million in the bank account, but the refinancer wants to know if this is a Krefo score of this or this, because they need to be able to slot that into their reporting in the background, or they need to be able to know, what is the risk-weighted asset cost of having this on my balance sheet to report to the whoever, CSSF, FINMA, whoever it might be. And you can never go wrong with the auditor if you tell them, I'm using S&P or I'm using Moody's or I'm using credit reform. So a lot of the problems that we have with using alternative data sources in our underwriting is that a lot of the LPs and refinancing partners, et cetera, want a known standard third-party kind of stamp of approval on it. And that's what they use for their internal calculations. So yeah, it's a big topic for us. And I think it's going to change obviously bit by bit. But at least in the B2B space, it's taking some more time to get really mainstream. I don't know, Andreas, if you're seeing it differently with some of your other cooperation partners and refinancing partners that you guys and your partners work with.
So, no, generally, I completely agree. I mean, obviously, digital adoption will happen, right? It's a matter of, is it fast enough for all of us who are a bit impatient and rather want it today than tomorrow? We see it. I mean, our shareholder Raisin Wealth platform. If I look there, the average customer is exactly this 60-year-old male with quite some money in the bank, who uses the digital platform to invest his personal financial assets across Europe. So, and from this personal experience, that will drag into the professional environment with a bit of delay. So people will get more used to open banking and see chances instead of threats that are connected to us. It's just a matter of time. The other question is what that Maik posed is, what types of scoring models can a traditional bank versus an alternative provider use? And of course, incumbent banks are very much regulated by EBA guidelines, by MRS, by everything that is out there. And it's not easy for them to say, okay, I'm scoring based on burn rate and capital, and not use the last 3 years of full account statements, and you need to be cash flow positive in order to get a loan in the first place, or even a credit. I think both worlds will meet, because I don't expect a lot of innovation out of traditional banks. But again, they have access to customers, they have liquidity and maybe capital if they're lucky. So they are very well interested to invest into these assets, but they may not be able, for regulatory reasons, for technical reasons. The average IT system is 30 years old. To even implement such models will be too hard for them. But they are very well interested in investing. So most of the platforms that we work with, they have a front end and an operator that is tech that can implement such models. And they have debt financing, mostly by very, very traditional banks. And there both worlds meet, right? The one is the front end, the sales channel, and the engine room. The other is the balance sheet, the risk, and the liquidity. And both together can work towards the customer and earn some money.
Okay, thank you. Maik, you mentioned some additional points, and one of it was profitability. What's your view on this?
I mean, so everyone wants profitability, but it stands in contrast to also growth. So I think you need to have like both in mind. The most beautiful thing would be profitable growth, which we're all aiming for. But interest rates go up, and also consumers' businesses are potentially being a little bit more cautious about taking loans. Maybe not. It's not the wishful formula one can just always strive for. So I think from our perspective, because we serve also a lot of companies in the fintech space, there is a push towards profitability just from a pure venture capital perspective. So it's as you were being rewarded as a young startup, as a fintech company between 2020 and 2022, by showing very high growth numbers despite of actually making good returns, being profitable. That is definitely in that very certain customer segment now that I'm mentioning, startups and fintechs. That is something where all of our customers have to have a mind shift. So instead of being able to show hyper growth, an investor tells you, how about proving your business model and show us that you can actually make some money. So, and that push from the investor side, from the venture capital side, onwards to startups and fintechs is definitely leading at the moment into a top priority for them to strive for profitability in 2024. And in order to get there are different ways. We've discussed a couple of those already. But I would be, very interested to hear as a fintech, not us as a software company for fintechs, but as fintech itself, from Patrick and Andreas, if you feel the breath in your neck from the investors, or you just keep growing the way you're growing in 2021. What's the real world evidence here?
I think that's not specific to digital lenders. I mean, at the end, if we disregard for a moment the last 5 years of heyday and free money and free VC money, it's always been normal to say every company needs to earn money at some point in time. We just forgot about it in the last years. And there were even founders who said, I never have the ambition to become profitable as long as I grow. I think that's the right of existence for any business is to work with a positive contribution margin and profitable at some point in time, and not in some point in time in 50 years, but within a reasonable time. If I look at Raisin Bank, we did the same journey, right? So when the bank was acquired by Raisin in 2019, we said, yes, we know we're going to invest into IT, we're going to invest into people. And of course, the investments I do this year are not paying back this year, but hopefully the next 1, 2, 3 years. But it was also clear that after a time, we need to be profitable as a bank, even more than a fintech. And that's what we did. So we have been profitable now for 1.5 years every month. And I think that's important, not only to show it to the VCs, but also as an employer branding, because people want to work in a company where they know it's still there in a year or so. And you want to get out of, short-term funding cycles at one point in time. So my ambition also when I look for partners is to see partners who strive for profitability and balance growth and profitability in a way that is sustainable, i.e. not depending on external funding until Kingdom Come.
Yeah, I mean, pretty much the exact same. I can just copy what Andreas said. So for us, it's also honestly night and day. So the investors, maybe two years ago were telling us grow, raise more money, grow. That's the most important thing. Now they're saying still grow, but there is no more money in the market. So get profitable. We've also been profitable on a monthly basis now since about 6 months. We almost broke even for the year last year, and still managed to do 3x year-over-year revenue growth. So we're quite happy. I think we also got we were in a sense lucky that also that management team and our investors kind of relatively quickly came to us and said, guys, wake up, the world is changing, change your plans to make sure that you get break even as quickly as possible. And we did, and it worked. But yeah, I think the companies, as Andreas said, who maybe are built with the business model of spending €2 to make €1 and don't have a way to fix that, I think probably are already dead or won't survive the year at least. And it's definitely a shift in the mindset of the VCs, the investors, but also of all the staff, of the employees and stuff like that. I think everyone's realized it by now.
Okay, thank you very much. I'd suggest to stop here to discuss Taktile's report, because in view of the time, I would very much like to move forward and to discuss also on top the regulatory environment. And here we have already heard open finance and AI. But first off, I would like to start with Basel III, which is quite important, especially for SME financing. And Mike Mayo, the managing director at Wells Fargo, believes that banks urgently need to prepare for the stricter capital requirements contained in Basel III, as they are likely to severely impact it. He also believes the new rules will create a lot more competition in the future. This means, in my understanding, that even good risks may no longer be serviced by banks in the future. Hence, is Basel III the big growth chance for fintech lenders? Andreas and Patrick, what do you believe in?
Teylor is not a bank and we're not regulated. We work with a very fantastic fronting bank called Raisin Bank. So I'll let Andreas answer this question.
I think overall there are a couple of trends who support and restrain both for fintech lenders and for banks. I think one of the challenges, I come back to Basel, I promise, is of course every distributed value chain in the financial service sector is still looked at with very critical eyes. And of course, I agree that the more partners are involved in any value chain, the more risks there are of managing outsourcings, of managing delivery, service levels, business continuity, information security. There are a lot of things. My feeling is that regulation is still adapting to that. They are used to have banks who do everything from customer acquisition to sales to product, IT, balance sheet, everything in one house. But these days are gone, and we are all sure that at some point it will not be your own IT hosting, but AWS or Azure or whoever. But it still takes time, and I think for the industry to find good solutions and for the regulator to find a good regulation on these distributed value chains, that's certainly quite a topic also for the next years. I think on the whole Basel IV really requirements, there are, of course, again, in terms of equity requirements, that's the usual thing, right? That of course requirements will increase and not decrease over time. That's pretty clear, which makes, the costs, the other costs, operating costs, risk costs, and so even more important because capital costs only know one way. I'm especially curious how certain classes will develop. So if I look, for instance, at credit cards, right? So the undrawn part of the commitment so far has a relatively low risk weighting that will dramatically increase with the new regulation. So will banks ever be able to tell you, it's fine if you spend 5,000 euros. We give you a limit, even though we know you will on average only use it twice in a year when you go on vacation? Or will banks say, we give you like 100 euro limits, and when you need more, just call us. We'll increase it for the 2 weeks you're on vacation, but I cannot give you any credit lines anymore. The same will be true for any other undrawn commitments. I think that is a big shift, and I'm curious to see how both traditional banks as well as alternative lenders will react to that, because these unutilized commitments, they will be under very much pressure with the upcoming regulation.
Okay, let me ask you an additional question, which touches on green transformation, and that has a lot to do with what you have just answered. Last year, PwC estimated that German banks need 200 billion euros for the green transformation. Some of their representatives say that they will not be able to achieve this alone. Where do you see the fintech lenders in this area? This time I ask for their role.
Yeah, I mean, for us, let's say everything, not just green specifically, but let's say ESG, sustainability linked lending is a very important topic. I think not just for Teylor, but for all fintech lenders, alternative lenders. On the one hand, of course, because we believe in, we have a somewhat of a moral responsibility to make the world a better place for our children, but also from a, let's say, capitalistic perspective. If you want to do sustainably linked lending today and not have it, done in a greenwashing fake way, you need good technology solutions to solve that, to make it work. Maybe if you're doing some kind of large infrastructure deals, it works to have someone sitting there with Excel. But if you want to do really sustainability linked lending in in high volume, small tickets, you need to have great technology to do that. So it's a huge advantage that fintechs have over traditional lenders, because we have the technology to be able to do those things. The second purely commercial reason is that one of the, especially last year or the last 18 months, one of the few areas that consistently has seen inflow of LP money was SFDR 8, SFDR 9 funds, as more and more pension funds, especially in the Nordics and in other areas, are significantly increasing their investments into, let's say, sustainability related funds, vehicles, etc. Which means that if you want to be able to tap into this money, you need to have a part of an offering. It's becoming, for a lot of investors, a concrete requirement in their portfolios that they need to do a certain amount in sustainability linked lending. And if you are the only one or one of the few ones who is offering a fund or a credit product or whatever it might be that can achieve this, then you can get much easier and potentially even cheaper and faster access to capital than your competitors who can't. So we have been working for quite some time now on an SFDR 8 fund. And maybe if all goes well and the regulation and investors work in our favor, we do plan to launch that sometime this year. And I think it's, in terms of tech, in terms of morality, in terms of funding strategy, it's sustainability linked lending is extremely important for fintechs.
I think this could be a big boost for the industry. I agree with Patrick. However, we are not there yet. And I think the industry needs to work also hand in hand with politics to enable that. If I look at all the challenges from a societal point of view, net zero, infrastructure, digitization, I mean, we have to deploy so much capital over the next 20, 30 years. And I'm pretty sure that the bank balance sheet alone and the federal budget, no matter how much Sondervermögen, special assets we make, that won't be enough to pay for all the challenges. So we have to create ways to deploy institutional money, also private money, into these asset classes. And I think the industry of digital lenders is especially well equipped to connect dots at the end. So to make this deployment happen. But as I said, at the moment, I see a lot of challenges that need to be solved on a politics and regulation level in order to make these assets accessible for these types of challenges. We are not there yet, but once we would be there, that would be a super boost for the industry.
Okay, thank you very much. In view of the time, please allow me my very last question, and this touches on AI. And this is a question for all of you. And what notable developments or trends do you expect, or have you already seen in this space?
Yeah, I'm happy to kick it off. So maybe two things. The one is, what can the European Union expect in terms of regulation? And then on the other side, what can AI actually do for credit lending and underwriting? And let's maybe start with, the very positive side. So the technology itself, everyone knows it a bit by now. People have used OpenAI's ChatGPT tool, and there's a lot of power. People are being amazed by what AI can do. And then, of course, the question lenders probably ask themselves is, what can I do with that technology for precise risk precisions? And I think one needs to put out there that all these more newer types of LLMs are just trained on the public internet. And the public internet doesn't have a lot of default rates available. So if you now ask ChatGPT if a consumer is going to default, or if Teylor would ask ChatGPT if one of the businesses is going to default, they will not give you a good answer. So I'm not so bullish on those new models, helping with the final risk decision. However, I think that, when Patrick mentioned earlier, he's not had great experience of getting data like accounting data or transaction data into the models. It's really cumbersome. I do see a lot of value of AI algorithms and models to actually create new signals for the underwriting process. Because even I mentioned earlier, people want to connect their bank accounts. But what do you do if you get 2,000 historical transactions of Taktile? It says Lufthansa, Zurich, Berlin. What is it? Is it a flight or is it a salary? Probably it's a flight, but how do you know that? So how do you tag, how do you label those transactions to actually make them available for the credit teams and the underwriting teams in the end? And that is something which is connecting that to regulation now, which is also possible and it's allowed. So like the regulator and especially the European AI Act, which is going to come in place in 2026, they don't really want you to use black box models for the final risk decision because it needs to be explainable and, does the data go somewhere where you don't want it to go? But actually, looking at data creation and signal creation, that is something where the regulator is much more relaxed about. And there I do see most of the power. And then in the end, you just use a regular scorecard or linear model to make the final risk decision, but you just have much more powerful signals created by the power of AI.
I couldn't agree more.
Okay. Do you want to add something, Patrick?
No, I mean, I agree with Maik. That's kind of from speaking from practice, that's how we've seen it so far as well. We do need to be able to, there's extreme focus on us being able to explain how we rate a certain customer. But Maik's right, you don't necessarily just need to use it for that part. You can also use it for kind of the preparation of the data and the logic and things like that. And that's also what we're looking into as well. If we look where are we going to be 5 to 10 years into the future, I do think that with AI, you can probably do away with most human underwriting, with most people involved in the process. But I think it's going to be a while until we get there. And I think that there's still some innovation needed exactly around the data. Probably if you look into the way that the majority of traditional lenders work, they've probably got a lot of unstructured data, a lot of data from old borrowers, a lot of data in different systems, and kind of taking this, linking it together with your process, with your portfolio and stuff like that. I think that's where AI can add the most value and will, in the short term already, start adding a lot of value.
But among the jobs in a bank, I think underwriter is still the safest to bet on in order for competition by AI. I see many other things that I would rather use AI on than risk decisions, especially because all statistical models at the end need tons of data that may not be available. And they are good at interpolating, but not extrapolating. So if I want to make a decision, do I give to a new customer group a loan? Historical data won't help, right? And AI won't be able to learn from historical data if you come to a new asset class or a new type of loan or a new type of customer, and their AI doesn't help. So I think AI in the underwriting process will play only a role in supporting with data, but not in actually making the models or making the decisions, not in the next years anyway.
I partially agree with you. I think the underwriter, as you have it in most banks today, I wouldn't say it's such a safe role. I think that's what's gonna happen more. Maybe today you have 10 credit analysts who are, or Marktfolge staff who are sitting there and looking at these loans. I think with time that there's going to be replaced by maybe one chief risk officer sitting together with a software engineer or a prompt engineer or whatever it might be in 5 or 10 years time. And that person will be the underwriter of the company. I think if I had to bet, I still think sales is always the safest role. That's going to be a while before AI can really replace that. But we'll check in again in 5 years, Andreas, and see who has the most and who has the least jobs.
Let's do this. If we are still needed in 5 years.
If we are still needed, maybe we'll meet up on the beach somewhere and talk about the good old times.
We will be meeting again in this podcast or on one of our conferences and get this thing discussed. I'm absolutely sure about this. So thank you very much. That was really a great podcast. Thank you, Andreas, Patrick, and Maik. Thank you for your time, for the wonderful pieces of information. I think for the audience, that has been a rush through many issues. And great that you have been here on the show.
Thank you, Constantin, for joining us.
Thanks for having us, Constantin.
Thanks for having us.
Thank you, everyone, for listening. I hope you enjoyed this episode. Please find the link to Taktile's State of Lending report in the show notes, and make sure you subscribe to our podcast and follow us on LinkedIn so that you will never miss our podcast. Stay safe and sound, and see you soon.